Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is AvalonBay Communities, ticker AVB. This company is in the equity real estate investment trust industry. It's a REIT, and over the next 5 minutes, I'll discuss both my valuation of this company and my thoughts on its business quality. Let's begin with the business description. So, as of December 21st, owned or held indirect ownership in 291 apartment communities, 86,000 apartment homes in 11 states. So it operates in the U.S., runs apartments. It's a real estate company. So that gives us our framing for this as well in places like New England, New York, New Jersey, Mid-Atlantic, Pacific Northwest, Northern, Southern California. So their base is in relatively expensive areas. That's worth noting. And they are expanding into Florida and Denver, Colorado. Also relatively expensive areas. Maybe besides Florida might be a little less expensive depending upon the city. Now, we go down here on return on invested capital. First thing that leaps out, you have 20 straight years of profitability. I always like to see that in terms of high quality companies. However, it's very cyclical, up, down on your returns on invested capital. It's not very clear what they're going to be. Makes it harder to predict. That's a negative on my ability to predict the future ability for this company to be successful. Now, when we go to 10-year median returns, the other piece here is you can see they're jumping between 2.5% and 7.5%. These numbers are very low. If you're unable to get more than a 7.5% return, really more than a 6% return on invested capital, then your return on equity is going to be capped. It's going to be very hard for you as an equity investor to get the returns you need to be successful. If you want double-digit returns like 10% plus, you really need returns on equity and returns on capital higher than 10% if you're going to hold over the long term. Now, there's ways you can handle it, and what they're going to try and do most likely is arbitrage between their cost of debt in order to hit high returns. And so you see these 10-year median returns, equity tops out at 7.8%. That means you as a long-term investor should never expect to earn more than 7.8% by holding this company. To me, that's a concern because that would be if you were buying the company at book value, which would be if you bought it at 1 times book. But instead, this company's priced at 2.6 times book or 25 times earnings. So it looks incredibly overvalued. You can also see price to sales of 12 times. Again, very, very overvalued based upon these numbers. I would never pay more than 10 times sales for a company. And that's what you're seeing here. Now, that's a little bit different with you're talking in real estate because of how REITs are set up. So sales operates a little differently, but it still tends to hold true. If something's overpriced at sales of 10, way too high in terms of valuation. If you're enjoying the content so far, please hit that like button and subscribe for more information. Now, the next thing we see is you have revenue growth of 9.8% and asset growth of 8.9%, while your free cash flow is going at 26%. So this is interesting when you compare to these two. How are you hitting these numbers? Because what's odd is that you're able to grow these numbers at 8.8%, but EPS is only growing at 4%. Why? Probably because debt is capturing a significant portion of your benefit here, which is why your EPS is growing so much slower. In addition, the only way you can grow revenue at such a high rate but be below your return on equity is you're going to have to be leveraging up. You're going to be using debt, and you're going to consistently be expanding it. You're also highly likely to be diluting yourself over time in order to do that. So they're probably issuing more shares, which we'll see if we dive in further. So again, nowhere in the last 10 years except one time has return on equity exceeded 10%. Not a good sign. Now, as we go to your income statement, again, please consider hitting that subscribe button, liking the video so that you can continue to follow along as I upload more investing content. Now, it looks clearly that I was right. They have been issuing shares outstanding. Now, it has slowed a little bit since 2017, but they had a lot of share issuance between 2012 and 2016, presumably in order to drive growth. The problem with this, though, is it helped them grow from a net income of $400 million to $1 billion in 2016, but they've been stagnant since then. They have not grown net income that entire time, which is really bad. It makes it really hard for a shareholder to get the return that they're looking for. When you look at your balance sheet, you can see that they're putting everything in under other assets. And so you can see they issued a lot of shares in order to grow to these $15 billion in assets there. But they have a lot of debt here. Your long-term debt is, half of that asset base of 8 billion, and that really drives a lot of your concern. You can see minimal retained earnings. They're not able to really get the earnings you need. And so if we go back to this income statement, how do we see that? So you're getting that income statement. Where's the cash flow breaking down? That's going to tell us the information. So you have cash flow from operations, and they're reinvesting that into, you had acquisitions and other, but they're having to issue this stock. There's no consistency of stock buybacks or stock issuance. Besides, relatively often you have stock issuance. You're always issuing shares through stock compensation, so you are diluting there. A big issuance of stock in 2012. They do pay a consistent dividend, but you have a little bit of an issue here, is that they're having to issue stock all the time. So why are you issuing stock if you're wanting to pay a dividend? It's kind of like you're issuing stock in order to be able to pay the dividend, because otherwise you wouldn't be able to do everything you wanted to do here. So a little confusing. They're required to pay that dividend is because they're a REIT. But it really puts you in a trap as a long-term shareholder. For me, I would avoid this company. Ticker AVB, AvalonBay. The quality is unpredictable, so I would say it's relatively low quality. Could be an average business, depending upon how you look at it. The returns on invested capital are simply too low to justify a long-term investment, because you can't predict the future, and the longer you hold, the more you're going to be capped out by this 8% return. If they want to grow faster than that, they're going to have to dilute you, which is what they've done. And the valuation here means that you're going to get even a worse return because the price to book is 2.6. So for me, I pass on AvalonBay. It wouldn't hit my watch list, and I don't think I'd ever look at it again in the future. If you enjoyed this video and you like my insights on investing, please hit that like button and subscribe for more great investing content. By ringing the bell, you can get notifications as I upload new videos. Thank you for listening, and until next time, stop paying fees, start building